Let's talk about credit risk. Credit risk is endemic to any lending activity, and it's the risk at the end of the day that one or more borrowers are not going to be able to make their payments, that they're going to default. There are ways to mitigate credit risk, including both procedures, quantitative data, and your gut feeling as well as a banker. Let's take a look at some measures. Credit risk is possibly the most pervasive risk in banking because it's essential to banking itself. No matter how robust the screening process may be for the borrowers, defaults will always happen. It's not a matter of whether they will happen or not, but a matter of how many will happen. In short, this type of risk cannot be removed, but only mitigated. Credit risk management, therefore, is possibly the most demanding discipline in terms of risk management, because all possible qualitative and quantitative criteria possible must be leveraged to minimize defaults. This is due to something called information asymmetry, which in short is the following. In the lending process, the borrower always has more information, especially more negative information, than the bank has. And the bank never has all the information that the borrower does. There is an asymmetry to what they know, and this results in something called adverse selection. In short, borrowers are obtaining cheap loans for the risk level that they present, because they present themselves as better than they actually are. So bankers must lend defensively. And also, usually, loans cannot be removed from a portfolio after the fact. In some select cases, sure, they can be sold, but it's not a reliable tactic. In short, banks must focus on getting the lending right because they can't fix it after the fact. In terms of credit risk management, there are four main pillars, and naturally we could go much deeper into every single one of those, but let me give you an overview. The first is efficient credit limit setting. This is possibly the most powerful principle, because here's the thing, if you set limits to credit, then no matter how severe the mistake, it's always controlled. If you can only lend 500 million total unsecured, it doesn't matter how much bankers want to grab more opportunities, that's the limit, period. And there are multiple limits. So first, derived from the Basel regulation, having limits to lending so that it never affects the regulatory capital of the bank. For those that are not familiar, regulatory capital is the capital that the bank must have due to regulation. It's a sort of provision or reserves dictated by the regulators as a cushion in case something goes wrong. Then, diversifying loan portfolios as much as possible helps. Naturally, banks and bankers may have specific sectors of expertise and specialization, but it's important to diversify as much as possible. For example, if the bank only lends to manufacturing companies, and there's a severe problem in the manufacturing industry, they will wish that they lend to bakeries or IT companies or others. There should be limits by industry, which is a good segue to the next point. A good control measure is setting credit limits per individual client, per geography, per sector, etc. This prevents the bank from being overexposed to any particular element. Just like there can be a severe problem with an industry, there can be one with a specific client, a whole geography, a whole industry sector, and so on. So limits help prevent exposure to that. Then, robust lending processes. In short, not changing the process when the bankers think it's convenient or that they can get more bonuses. So one principle is not enlarging portfolios in bull markets or lowering the criteria for borrowers. That's precisely what happened leading to the 2008 subprime crisis. Banks ran out of good borrowers, so in order to get more bonuses by lending more, bankers started lending to individuals who satisfied less and less criteria. And then it all came crumbling down. Besides this, intimately knowing businesses and sectors is a must. Every banker must know the industry of their borrowers, how it works, and how promising the specific borrower is. If you get into a business you don't understand, you will not be able to measure the status of the borrower or covenants such as coverage ratios, or even know what's going on with them. So the lending process must be robust. And then it's all about analysis, quantitative and qualitative. Quantitative analysis is using computer models. So modeling risk comes from this. It's having the wrong models that don't properly estimate the risk. There are certain risk parameters which are frequently calculated, such as the probability of default, the loss given default, the exposure at default, and more. And we'll take a look at these in the next slide. But in short, it's reducing the loan to numbers and gauging whether the numbers are satisfying. That's it. Now here's the caveat. It's important to state that this should always be complemented with qualitative analysis. The numbers never tell the whole story, and they may be misleading. They may hide negative factors, or even positive ones. To give you a very basic example, if you reduce the cash flow to numbers, and you see that sales are high month after month, that sounds good. But if you visit the company and you see that all salespeople use high-pressure tactics, you know that customer churn is about to come, and that is not conveyed in the numbers. Reputation or customer churn are usually known in a quantitative analysis, and this is just an example, which is why the fourth criterion is qualitative analysis. This is understanding the soft side, if you will, management, leadership, the business outlook, how the company is run. It's about visits, meetings, looking people in the eye, and just following a gut reaction as a banker. Within these four pillars, the quantitative characteristics are important to understand, and specifically the major risk parameters, which are three. These will be very present in all types of quantitative analysis. The first is PD, or the probability of default, and it is exactly what it sounds like. It's the likelihood of the borrower defaulting from 0 to 100. It can be derived from internal or external data, and usually from statistical models. Out of curiosity, external data can usually be used for bigger loans because they're easier to predict, but smaller loans, such as bakeries, coffee shops, must use internal data because they're so unique. Usually, they depend on local economies that have such unique characteristics. So if you're lending to the biggest manufacturing company in your country, you can probably use an external model. If you're lending to 100 bakeries, you probably need to create an internal model. And naturally, in many cases, these have to be created from scratch when they don't exist yet. So that's the first criterion. The second is LGD, or loss given default. Also very simple. It's the loss that the bank will take if the borrower defaults. Is it 50 million? Is it 100 million? Is it 1 billion? And so on. It's important to understand this is not just the dollar value of the loan itself, but it includes other factors, such as liquidation costs or valuation costs. Let's say that a manufacturing company defaults and they use a machine as collateral. You are going to have that machine valued by an expert. You may have costs in actually storing it while it's being sold, or even commissions to dealers or brokers for an auction or a private sale. All of these are included in the LGD. And there are multiple methods to calculate it, which can include statistical models, expert judgment, or others. And then we have exposure at default, or EAD. And it's exactly the same as the loss given default, but this is the theoretical value. So if you're facing a 50 million loss, if a borrower defaults, that's the exposure at default. But let's say that you put up collateral and you sell a machine and you get 40 million back. So your loss is actually 10 million. That's the LGD. The 50 million, the theoretical loss, is the EAD. It's the current exposure if the borrower defaults. It's not necessarily the loss, it's just the possible loss that you are exposed to. It's important to note that it usually changes with time, as portions of the loan are paid off. If it's an amortized loan, for example, it's usually the current amount outstanding. So let's say that it's a 50 million loan, and besides the interest, the borrower also pays 5 million per year. So it starts as being 50 million. The next year, it's only 45 million, and so on. It's the current exposure. It's important to note that if it's not a term loan, but instead a revolving credit facility, then instead of just the amount outstanding, the total exposure is also the estimated amount in addition that will be used over the life of that facility. For example, there is 100 million outstanding and the borrower is predicted to borrow 20 million more. So the exposure is 120 million. Very simple. What are some examples of credit risk? The first is that probabilities change. The PD, or probability of default, can be modeled using a multitude of tools, including statistical models that take into account past performance either from internal or external sources. Remember, for retail lending, it's much more unique and it needs internal modeling because smaller loans are so specific and tied to the local economy. Then it starts with the limits. Setting efficient limits and responsible ones is a foolproof way to model a robust process. If you just can't extend low-quality loans, then a lot of the rest of the process just takes care of itself. Then, using only machines can backfire. Using statistical models to compute probabilities is good, but qualitative data must complement it. There is a lot that the numbers may miss, which may result in bad loans, or missing good loans, false positives, or false negatives. What are our key takeaways? The first is that credit risk is pervasive and necessary. It's endemic to the banking activity because it's a necessary component of loans and it cannot be eliminated. It can only be mitigated, and that's the paramount rule of credit risk. Then, there are 4 major ways to manage credit risk. Number 1, efficient limits. Number 2, a robust process that doesn't change depending on the cycle. Efficient quantitative analysis and efficient qualitative analysis. Finally, there are 3 quantitative metrics that are important for any type of quantitative analysis. The PD, or probability of default, tells you how likely the borrower is to default. The LGD, or loss given default, tells you how much you lose on a default, including the costs to liquidate the collateral or the portion of the money that you get back. And the EAD, or exposure at default, tells you your current exposure over time, the theoretical loss, and it changes as the outstanding limit changes as well. So as we see, credit risk cannot be eliminated in lending activity. It can only be minimized. And the 4 pillars that we've covered do help a lot. Setting efficient limits, having a robust process that is not swayed by banker opinions, having good quantitative data, and finally, having good qualitative data. All of these help mitigate the defaults at the end of the day.